How do organizations use debt financing in contemporary capital markets? Debt financing has many forms and many purposes. The amount and type of debt financing depends on the requirements of the business and the goals of the investors. Let's start with a view of debt capital markets, as they can change very quickly. They can go from being very hot when the window is wide open to being very cold when the window is closed to being wide open and very hot once again. During 2007 and 2008, the debt markets essentially shut down after an extremely exuberant period, and it was extraordinarily difficult to obtain debt capital for either acquisition or new development projects. During the recession that followed, debt was only available for a select number of high-quality projects at terms favorable to lenders. From 2012 to 2016, however, debt capital became plentiful at rates favorable to borrowers, and standards were relaxed compared to historical norms. Borrowers obtained large loans with terms that were generous compared to terms in the market just a few years prior. Now let's consider the requirements of the business and the goals of the investor. We'll introduce the four primary reasons to use debt capital and discuss each in turn. First, to promote internal growth. Second, to promote external growth by developing or acquiring new properties. Third, to recapitalize the firm. And lastly, fourth, to change the capital structure in order to facilitate a sale. First, we use debt financing to promote growth within an existing property or properties. Funds are generally borrowed to perform renovations, additions, or change the way spaces are used. Typical additions include a new guest wing, a new meeting space addition, or the addition of residential units. Examples of space utilization changes include conversion of underutilized space into a spa or business center, or the expansion or reconcepting of restaurants, clubs, and lounges. For new acquisitions and new hotels, larger loans are needed. It's a classic growth story. The developer finds opportunities in the market and can grow by taking advantage. Given the historical constraints on developers in the amount of capital they have available and the beauty of financial leverage, debt capital is central to most firms' development and acquisitions growth strategies. Lenders have long supported lending to borrowers who wish to use debt capital to grow their businesses as an alternative to using equity for growth. However, there is a challenge in the choice of whether to use debt or equity capital. In making the decision, owners must consider control, speed of growth, and risk. In general, one can move much more quickly using equity capital alone rather than using debt capital. The debt capital market has to underwrite and approve a project in addition to the equity investor's own decision process. A common approach is to use equity in a short-term construction loan to perform the development or acquisition and then secure a mortgage on a stabilized asset. Equity is harvested by adding debt to the property once the project is stabilized. In addition to funding changes in a property to acquire new, debt capital is often used to recapitalize the firm. This changes the relative amounts of debt and equity within the capital structure based on the firm's need. Ordinarily, what firms do is add debt, reduce equity. What successful real estate investors discover is their least expensive source of funds for new projects is often to refinance their existing buildings and use the proceeds to fund new opportunities. The last way that debt is used is to think about using debt to change the capital structure to make the firm or individual assets within the firm much easier to sell. In other words, create a capital structure that's conducive to a transaction. In one of its most common forms, this involves taking a set of partnership interests, which may be diverse across different investments, into a limited liability corporation or limited liability partnership structure that can be sold easily as an equity interest. Once the new structure is in place, debt capital that is spread across a number of individual investments can be replaced with a consolidated debt package that's easily prepaid if the company is sold. Overall, when using debt capital, you must choose from a complex array of options in an environment that itself can be volatile. You can only make wise debt financing decisions by considering your organization's situation and the state of the external marketplace, which can change quickly.